Hey, what is up everyone, it's David here. Now, since you guys really enjoyed that how to research ASX stocks video, and some of you even mentioned that you prefer me to do longer form type tutorials with little editing, I decided to do another one. But this time I'm gonna focus on how to read annual reports for investing. Now, I've created this video to be as beginner friendly as possible. So at the end of this video, you should have enough knowledge to read an income statement, a balance sheet, and also a cash flow statement with no problem. And throughout the video, I'll talk a little bit about some of the basic metrics that we use when we evaluate companies so that when new annual reports come out, you know how to calculate them on the fly and you know where to find the information to calculate them. Now I'm gonna focus on the core things in the annual report. So I am bound to miss out on things that you might potentially want to know. So if there's anything that I missed, just let me know in the comment section below and I'll write a specific answer for that. Now we'll use Bubs Australia's annual report as an example. So I'm gonna take you into my computer and we'll go through all of the financial statements together. I'll think out loud so that you can hear how I'm interpreting the annual report. So first things first, we need Bubs Australia's annual report, and that's pretty easy. All we need to do is just okay, cool. So now with any annual reports, there's usually 4 financial statements you have access to. You have a profit and loss, which is just an income statement. Financial position, that's essentially a balance sheet. And changes in equity, that's exactly what it sounds like. And cash flow statement is just cash flow statement. Now, accompanying these 4 financial statements, there's usually a notes section. And the notes section is to provide clarity around certain line items that is super vague. I'll talk about that a little bit more when we dig into the statements. Now for me personally, I spend majority of my time in P&L, balance sheet, and also cash flow statement. I don't really spend a lot of time here just because I find the other 3 statements are way more helpful in helping me understand a business. So let's get started with the income statement. Now the good thing about Bubs Australia's profit and loss, income statement that is that it's just so nicely laid out for you to read. And I might zoom in a bit here just so that you can see better. Let's go from top to bottom. Now revenue is just anything that's core business related. All of the sales numbers, that's where it goes. Now everything that's outside of core business, that could be selling off your interest in joint ventures, or basically there's nothing related to selling milk powder, it goes into other income. Now cost of sales is essentially just the costs associated with producing the goods and services. So in this case, it will be the costs associated with producing the milk powders, or just any of the Bubs Australia products. Now what we're really looking for here is growth. Now this is a growth company, right? So you do anticipate that the revenue has grown from 2018 to 2019, and it's a big jump. And you expect that because this is a high growth company. Now the cost of sales would scale with that accordingly as well, because well, you got to spend money to make money, right? And other income went from 193,000 to about $1 million. So we'll probably need to dig into this because this is a massive jump, and usually anything that's vague you want to dig into, just because you don't want any surprises. And most of the time they're hidden within the notes. Well, they're not hidden, but like they explain further in the notes. So you should go to that section if anything that's unrelated. Now let's go through all of these first, and then we'll jump into the notes to find a little bit more clarification. Now distribution and selling costs, that's exactly as it sounds. Employee costs, that's just headcount. Marketing and promotion costs, that's exactly what it sounds. And it seems like there was a massive jump, which is fair because they're obviously making a lot more money, and you know, again, you gotta spend money to make money, right? Occupancy costs, that'll be rent, admin and other costs. We should probably dig into this one as well because I wonder what's inside the other costs. Whenever everything is lumped together and it sounds vague, you should probably dig into it. Again, you don't want any surprises. Goodwill impairment, that's just essentially when you acquire a brand or a company, you can write down their intangibles, if you will, as an expense. Share-based payment expense, corporate transactions. This is a big line item as well, so we should probably dig into this one. Other expenses, I'm not too concerned about this. This went down, which is nice. Loss before tax about 35 million. It was 66 million last year. Now, I know this number probably looks crazy, but goodwill impairment was basically a big chunk of this. And goodwill impairment is actually not a cash outflow. So it's more of an accounting adjustment. So even though this number looks big, regardless, from 2018 to 2019, having a lower loss before tax is a good thing. So, take that at face value. And then loss for the year after tax. Now, normally you will hear a lot of us talk about EBIT, EBITDA. I'll explain that in just a second. But usually with EBIT, that's just earnings before interest and tax. Now, if they made money, this will be earnings before tax. And then you just have to basically reverse what they did over here to get EBIT. And then EBITDA will have to find where the depreciation and amortization expense is to essentially reverse what they did. And then I'll explain that a little bit more because I have Excel sheets dedicated for that. So, okay, so that's essentially it for the income statement. And the one last thing here is if they made a gain, that will be basic earnings per share and diluted earnings per share. Now, you probably already aware of what earnings per share is, but I think the one thing that you need to know when it comes to diluted or earnings or loss per share is just that sometimes executives hold some kind of securities that can be turned into stock. And if those were to turn into stock, there's more stock in the pool of common stock that's available, which ultimately would dilute the earnings that you would get. And so this is more of a, I guess, conservative guess that if they were to exercise some of the options or more stock are introduced, what would that do to earnings per share or loss per share? So in this case, this hasn't changed, and this number will always be lower than earnings or loss per share. There's just no chance that will be higher. So let's look into some very basic metrics for income statement. Now, one of the first things that we need to look at is, I already talked about the improvement from 2018 to 2019. So the revenue has grown, and if you want to go a step further, what you want to look into is gross profit and gross margin. Now that tells you how have they been able to scale the production for these products that they're creating, and are they becoming more profitable? Because ultimately, as you sell more products, you should have something that's called economies of scale, because you're buying inventory in bulk, and when you buy in bulk, you should get a discount. So when you scale the processes to be bigger, you should also reap some benefits with it as well. So the easiest way to calculate gross profit and then gross margin is just add the revenue and other income together minus the cost of sales, and then you'll get gross profit. And then you will just basically do gross profit divided by the total revenue for the company for that year. As you can see in the formula here, it will just be gross profit divided by that and that together. You get a gross margin of around 21%. Now this is great because from 2018 to 2019, they have increased their gross margin by almost 11%, and that's incredible. So that means that there is 21% income that's left over that can be spent on other things. So instead of having 10% left over to spend on other things. So this is a really good sign that the company is trying to move towards profitability. So that's a really healthy sign to look at. Now, I talked a little bit about EBIT and EBITDA. Now, when it comes to EBIT, again, it's usually this line item here before tax, and then you want to reverse what they did over here to arrive to this number. So normally they will do, the brackets are a minus and the normal numbers are a plus. So they would have done that plus this minus everything else plus interest income to arrive to this number. To get EBIT, you just need to reverse what they did over here. And in this case, it would be they minus 893 finance costs, and then they also added interest income. So we'll just basically do exactly the opposite to get EBIT, which is about 35 million. Now, for some companies, you also want to look at EBITDA, because whenever you use EBIT and EBITDA, is usually used in a way to compare one company to another. It's more of a comparative analysis to see which company is potentially more efficient at generating income. And with some companies, they actually have a lot more fixed assets. That could be machinery, it could be, and they might have bought out companies during the year. And when they write down the intangible assets from the other company, there is a lot of depreciation and amortization. So if you have one company with a lot of fixed assets and have bought a company, and another company who hasn't really done that much on that front, you want to basically remove the depreciation and amortization so that they're on the same level and you can have a fairer comparison between the two companies. That's the whole point of doing comparative analysis between, using EBITDA and also EBIT as well. And I'll show you how to get the depreciation and amortization expense in just a second. But first things first, I just want to quickly explain the difference between depreciation and amortization. So basically the concept with depreciation is that let's say you have a laptop and the lifetime of this laptop is about 5 years and is worth $1,000. Now in accounting, basically every year you can write down the value by about, say, $200 until the 5 years have lapsed. And that can be treated as an expense. So that would be a depreciating expense. Now, depreciation is for fixed assets and basically anything that you can touch, tangible assets. Amortization is the exact same concept, except it's applied to intangible assets. That's it. That's ultimately is it. So there's no need to complicate it. And yeah, that's essentially it. So to find amortization expense, I already done some of the hard work, and it's actually inside administrative and other costs. And to do that, we need to go to the notes. Give me a second as I go to the notes. Okay, so I found it. Now, as you can see here, the other costs include, so those are essentially, accountancy, legal fees, insurance, travel. So it's right here. So to get EBITDA, you basically just want to reverse what they did over here. They would have minused, if I go back to the income statement, they did a minus over, they would have taken that out from the revenue as an expense. So basically you just want to add that back in to get EBITDA. So if you add these expenses back in, your EBITDA will be 33 million to negative 65 million. And ultimately you'll use these numbers as a way to compare between companies. And you also want to see, and at the same time, you normally want to do multiple years as well. So for the purpose of this exercise, for this video, I'm not going to go into 2017, 2016, but normally you want to look at multiple years and see how they've improved, and then you compare that with another company. Now, that's essentially it for income statement. There's no need to complicate it. That really is it. And maybe one more thing, let's check what's inside other income, because that was a massive jump and we just want to know what that is. So give me a second as I go to note B5. Okay, I found it. So for other income, it seems like it's normal, except in 2019, they sold off their interest in their joint venture. So that would have been just a one-time gain for selling off their interest in the joint venture. So, okay, understood. So we'll probably won't see that in the 2020 annual report unless they did something else. Yeah, so that's fine. That's nothing to be worried about. I think the one thing I want to make note of in the income statement is just that whenever you interpret annual reports, after you read the annual report, you should be more comfortable and more confident that you understand how the business operates. That really is the purpose. And anything that is super vague, like for example, whenever there are big differences between one year to another in really vague line items, you should dig into the notes section just to clarify and to understand where they're coming from and why is there such a big jump. You should never see anything that's like really odd and not pursue it. So you should definitely pursue that. Now the balance sheet is probably one of my favorite financial statements. That's a really nerdy thing to say. And it's usually broken into, well, I mean, there's really just 5 sections or 5 segments, if you will. You have current assets, non-current assets, current liabilities, non-current liabilities, and also equity. Now, the way I understand this is just anything that's current, it means that it can be liquidated in 12 months and used as cash. Anything that's non-current, it means that it takes longer, beyond 12 months, to basically essentially liquidate it. And all of the line items that usually go in here are like bigger things. Like, for example, if you're mining, it'll be like massive machinery or mines that you just takes ages to sell. And buildings will go in here as well. And current liability, essentially all the bills you have to pay within the first 12 months. And then the non-current liabilities are things that are due beyond 12 months. And then equity is essentially assets, all of the total assets minus the total liabilities, and you would ultimately have equity. Now, let's go through each of the items. Cash is straightforward. Trade and other receivables. Sometimes companies might sell things in credit, and that will be treated as accounts receivable. Other assets, just basically anything else. GST receivable, inventory, okay. Plants and equipment, intangible assets. These are very straightforward. Usually when you read the balance sheet, you know exactly what it is. Only for the things that it's vague and you don't quite understand it at first glance, then we should dig into the notes. These are all very standard provisions. Employee liability. That might be just benefits that they're supposed to pay the new company, and they're essentially just putting that money aside to reserve for these people. Deferred consideration payables. We should probably dig into this one because I don't know what that is. Considerable consideration payable. Okay. Provisions. Okay. Issue capital. So you can tell that from 2018 to 2019, they've essentially issued more shares to raise money. We'll find out whether they did in the cash flow statement as well. So we'll go into the cash flow statement in just a second. Share-based payment reserve. Okay. Foreign currency. So the thing with accumulated losses is that usually this line item is either retained earnings or accumulated losses. Now, accumulated losses essentially just means that this company has made a loss in multiple years. I think the one thing we need to understand when it comes to accumulated losses is that over time, you want to see this to be reduced substantially. But because this company is in its growth stages, you don't expect them to make a profit yet, but hopefully very soon, so that they can start getting rid of these accumulated losses. Now, if you see accumulated losses in a mature company, that's a problem. So this is not a mature company, so I wouldn't stress out too much about this. And before we dig into the notes, a common metric that I look for in a company is the current ratio. Now, the reason why I look at the current ratio and also debt to equity ratios is just because if the company doesn't make a cent for the rest of the year, are they able to pay off all of their current liabilities? Because if they can't, that's a problem. It means that this company is not very liquid, and it means that they're also very fragile. If a sudden external shock hit them, they wouldn't have enough money to pay off all of the liabilities. And if that's the case, it means that they might go into distress. It's just ultimately playing in very dangerous territory. So to calculate current ratio, you just want to do current assets divided by current liabilities. And if you have a calculator, so you go 56978 divided by 28099, you should get about 2. So that means for every $1 of liabilities, there's $2 worth of current assets to cover it. So what you're really looking for here is the higher the current ratio, the better it is. So the more that the current assets can cover the current liabilities, the safer the company. Now, you still wouldn't really want a 1 coverage, like if you have current assets divided by, if you have the same amount of current assets to current liabilities, yeah, it's still okay, but you always want a little bit more because you never know what's going to happen. So for me personally, I like current ratios to be above 1.5. There's no reason, I have no justification on why 1.5. And frankly, I like to see current ratios to be higher if possible. Now, something else that I also look at is debt to equity ratios. Now, with debt to equity ratio, there's a couple ways to do this. Some people will do all of the liabilities divided by all of the equity. So it'll be 48 million divided by 105 million. Personally speaking, I don't like to do that. I like to look at interest-bearing debt divided by equity because when push comes to shove, the banks get first dibs. Basically, any bondholders' interest payments that's owed to the banks, they get first dibs. Everything else has to wait. So really, what you're looking for is any form of debt divided by equity will give you a much better, accurate depiction of how much interest-bearing debt there is against equity. So borrowings could be 1, and that's it. So it's 2 million divided by 105 million. Is there anything else? Really? And I usually like to check against simply Wall Street just to see if my numbers are right. Bubs. So sometimes I like to check my debt to equity ratios against another form of software just to see if I got the right number. Now it seems to me that the only interest-bearing debt is borrowings. And it doesn't seem like anything else. So I'm just gonna double check against simply Wall Street. That seems to be, yeah, okay. So that seems to be right. So that means there's 2 million against 105 million equity. And that means the coverage, if you go just 2 divided by 105 as a just quick calculation, they basically have no debt. And that sounds about right for growth companies as well, because banks generally don't like to take that kind of risk. Okay, cool. So with the balance sheet, what you're really looking for is just current ratios. So current assets divided by current liabilities, and then you want to look at debt to equity. Now, there's 2 ways to do debt to equity. You can either do the total liabilities and divide that against equity and get a debt to equity ratio like that. But personally, I like to do interest-bearing debt divided by total equity because bondholders get first dibs, and you want to assess how many times can your equity cover the interest-bearing debt, because those are the people that you need to pay off first. Sounds bad, but some of the other people can wait, and that's the reality of the situation. And that really is it for a balance sheet. It's really not that complicated. And I remember saying that I need to dig into something. Yeah, so let's dig into deferred consideration payables, just because that sounds odd and I don't understand what that is. So give me a second as I scroll to note E. Okay, so I think I found it. Basically, they've just acquired Deloraine Dairy Group in April 2019, and I think as part of the deal, they have just reserved a certain amount of dollars for that. And the deal is worth approximately 38 million. They paid about 16 million in cash, and then 11 of that is deferred, and 5 million is in current assets, current liabilities, which is what we see, and then the rest is actually in non-current liabilities. Okay, that makes sense. I feel comfortable with that. again, I just want to make a note here that most of the time when you read financial reports, you just want to make sure that there's no stone, you didn't leave any stones unturned. If there's anything that you feel like is complicated, you don't understand it, make sure you dig into the notes so that you feel comfortable with it. You should never just glance over it and go, oh, I don't understand it, and then skip over it. If you don't understand it, just make sure you go to the notes, because I'm pretty sure they're going to provide clarification. And the final statement we look at is not changes in equity, but a cash flow statement. Now, a cash flow statement is broken really into three parts. You have your operating activities, and that's where they, think of this as the core business cash flow. So when they sell the products and all of the operations, how much cash flow did they bring in and how much cash flow did they burn? And then investing activity is essentially investing in manufacturing and whatever the case might be. And financing activities, that's when you see, if they ever issue dividends, I doubt they ever will. And it'll be somewhere around here. Any share issues, the capital that they raised, anything to do with financing, it'll be really here. So there's really just three parts to the cash flow statement. You have operating activities, investing activities, and then also financing activities. Now, what we want to see is that moving forward, firstly, because this is a growth company, you don't expect the operating cash flow to be positive yet, because they're investing heavily towards essentially scaling the company and then kind of moving towards profitability. We're starting to see that shift already happening in their growth profit margins. But as you can see here, from 2018 to 2019, they are increasing their burn, essentially doubling their burn. And obviously they made more money, which is really nice. But let's keep going. Investing activities. So if you watch some of my previous Bubs videos, then you know that vertical integration for Bubs Australia is important, and they spend a lot of money in that. They bought out multiple companies. They made sure that they control the supply chain from end to end. So it seems like there's a bit of slowdown in terms of investing activities from 2018 to 2019. They did do a lot of things in 2018, so we need to see more information. Like usually when you read these annual reports, you want to see multiple years, and because 2019 annual reports usually include 2018, you essentially want to skip 2018 and go to 2017 and see what the comparison is, so that you can compare them from 2017, 2018, 2019. But in this case, it seems like they're slowing down the investing activities. So they purchased a little bit more property, which is fine. Payment subsidiaries. Okay, so they bought out companies, of course. And they got a little bit of money from buying out, selling off their Coach House dairy assets, and then financing activities. So they're raising more money via shares, exercise of options, capital raising costs. That's pretty cheap, 44,000. Who did this capital raising deal? Repayment shareholder loan from Deloraine. Okay. So ultimately, this cash flow statement usually tells you the cash balance at the beginning of the year and then cash balance at the end of the year. Now it seems like they've burned approximately $15 million worth of cash, including the capital raising that they did. Now, for growth companies, you almost want to assume that they can continue raising money, but continuously raising money is not a sustainable practice. Can't keep raising money forever. So I anticipate that hopefully in the next 1 to 2 years, they're going to get very close to profitability and they'll start generating positive cash flow. Otherwise, it's very hard to keep justifying. It's very hard to keep raising money if you can't prove to shareholders that you can turn a profit. But at the same time, you also have Silicon Valley tech startups that doesn't do cash flow positive for a long time. But this is a consumer company, so you expect them to make a profit very soon, hopefully. Yeah, and that's ultimately it. I mean, it's pretty straightforward to read through the cash flow statement, and also kudos to Bubs Australia creating these financial statements to be really easy to read. Most of the time with some other statements, it's just awful to read. And what you're really looking for in cash flow statement is that you want to see an increase from in the operating cash flows moving forward. And hopefully, I'll be really excited to see the 2020 annual report in terms of whether they. I don't think they have a positive operating cash. Wait, do they? Operating cash flow. Did I miss a report? Oh, okay, so they did. Okay, great. I forgot I read about that. Okay, so that's awesome. Now, this is a quarter. I think overall, the year might be, like the entire financial year could be still negative. But the good thing is they're starting to turn a positive cash flow in their operating cash flows. Third quarter. So third quarter will be January to April. And they have a positive operating cash flow of 2.3 million. Maybe they can turn a positive cash flow for the fourth quarter as well. That's optimistic. So essentially that's how you read a cash flow statement. You have your operating activities and then investing and financing. Really, you want to see an improvement year on year when it comes to the operating cash flows, because ultimately that's starting to show that the company can turn a profit. Without a positive operating cash flow, it's hard to keep investing because you're just burning your cash reserves. And it's okay to talk about this now and see a negative operating cash flow because they're a growth company, but you can only do this for so long. So now, before I wrap up this video, if you want to support this channel, just make sure you gently smash that like button right there. And if you want a free stock in either Dropbox, GoPro, or Nike, I'll leave my stake referral link in the description box below. No, I'm not sponsored. I just use it because it's really easy for me to use and it's just much more affordable compared to other platforms. And my closing notes on reading an annual report for investing is that it's not meant to be complicated. You should be able to read it and get a really good understanding in terms of what the company does, how they progressed. So if you have any questions, again, just let me know in the comment section below and I'll write you a specific answer. Now, in the next video, I'm going to be doing that on Tesla. And Tesla's earnings call have just finished and I watched that this morning. I'm really excited to share my research with you. And if you want to know when that video is ready, just make sure you subscribe to my channel, click on the bell. When that video is ready, you'll be the first one to know. As usual, Otto is going to do the honors and I'm going to see you very, very soon.